But I believe the campus has power. We were afraid we were going to lose power, so I stayed home this morning just in case.
They do have power. They had one tree branch that came through the roof in York.
Oh, no.
Wow.
Yeah. But it happened overnight. Nobody was there, so nobody got hurt, which is good.
Oh, wow. Any damage?
Yeah, but it's not significant. So luckily it was just a small branch that came through the roof. So I think it'll definitely be below the property insurance deductible. Probably, I'm expecting around 15 or 20,000. So could be worse.
It always is, Gretchen.
Yeah.
Always is.
Good morning, Mark.
Well, Ellen, I did have power in North Brewer.
Well, South Brewer does too.
Okay, good. My daughters are going to school this morning. I got the text message, so I felt good about that.
Yeah, several schools canceled.
Yep.
Good morning, Kelly.
Good morning. Am I? Can you guys hear me?
Yes.
Okay, good. I wasn't sure if I was muted or not. So I think we missed the significant winds. We had some gusts, but we lost most of our snow. Just glad the snowmobiles are not in the backyard. Maybe sitting on green grass.
Well, there's more to come.
That's right. That's right. The storm's pretty much done down your way, right? It's just a remainder for us.
We're still getting rain and wind probably through midday.
Yeah.
I'm sure that messed around with a lot of cyber shopping on Monday. All the people that had outages.
Trustee Martin, we're almost at 9 o'clock. We'll wait just a couple more minutes. And I'll just let everybody know we are live on YouTube as of now.
Excellent. Well said, Ellen?
Yes. Kelly, why don't you go right ahead?
Okay, so I'd like to call the investment committee meeting to order. I hope everybody had a wonderful Thanksgiving weekend. I know it was a little bit different this year, but hopefully everybody was able to rest and get some online Christmas shopping in. And without further ado, I'm going to turn the meeting over to Ellen to take a roll call.
Great. Thank you very much. Good morning, everyone. I'm going to go through the list of committee members first, and then I'll check other folks, as we do have some folks joining by phone, likely maybe because of power issues. So first, the trustee committee members: Trustee Bartholomew,
Yes.
Trustee Irwin,
Present.
Trustee Gardner,
Present.
Trustee Eustace,
Present.
Trustee Martin.
Yes.
That is all that we expected for trustee committee members. Are there any other trustees participating? Okay, I do know that we have some non-voting committee members. I believe Eric Hayward is on.
Present.
Robert Blackwood
Here.
and Peter Dandy, or Peter Hardy, excuse me. Okay,
Third time is the perfect one. It's Handy, Handy. But I do get Dandy and Hardy from time to time.
I know we have is Cap Trust on yet? Oh, there's Barry
Yes.
Yeah, and Mike as well.
and Mike is on. Okay, who else do we have that I have not called?
Regine Mirage, University of Maine, Fort Kent, Student Board Representative.
Thank you. And is there anyone on the phone? Okay, I think we are ready to continue, Trustee Martin.
Excellent. And just a reminder, if you're not speaking, to keep your mic muted. And without further ado, we are going to go to tab 1, the FY 2022 endowment spending rate. And I'm going to pass the floor over to Tracy Elliott to go over the endowment spending rate.
Thank you, Trustee Martin. Good morning, everyone. This item today is an information item. Typically, we do bring an action item at this point, but with the budget uncertainty, the CBOs are taking a little bit longer to analyze the effective spending rate and what they need to support their endowed spending, their scholarships. But we'll bring this back to you in March. Just to let you know, we've had a spending rate of 4.5%. Pretty much since the financial crisis. We ratcheted that down from 5%, but this allows us to not invade our corpus and given the volatility in the markets, and allows for a long-term preservation of our endowment. But again, they will reassess that. The 4.5% would support a spending rate of $6 million for fiscal year 22, and that's up about 100,000 from what it supports today. There are, about 6 underwater endowments out of the 1,100 programs that we have available. So we've actually managed to, over the years, come back from where we were during the financial crisis, where there was a significant number of underwaters. And we do have a policy as an organization where we don't invade the corpus. Sometimes they go underwater simply because volatility in a current year will drop an endowment below the market value. I'm happy to take any questions, but I just wanted to give you a heads up because this will come back in March. We will distribute the budgets to the campuses pending your approval, and we'll need to adjust if whatever recommendation comes before you is readjusted. But want to take any questions that you have now and let you know that this is pending further approval. All set? Thank you.
Thank you, Tracy. The second item on our agenda is defined contribution plan, and I'm going to transfer the meeting over to Mike Pratico and Barry Schmidt of Cap Trust.
And I'm going to share my screen if that's okay.
Sure.
All right.
Okay, well, thanks very much, everyone. This is Mike Pratico. I'm going to kick things off with some market commentary and a few just kind of topical spotlights of things that are going on in the retirement industry. And then I'm gonna hand it over to Barry. Barry's going to cover the quarterly review and discuss a couple of specific fund issues that we wanted to talk about in detail today. But starting on page 11, sorry, I always get mixed up with the page numbers. So page 11, if you're looking at the full packet, and Barry, I think, is going to pull this up, titled Final Frontier. These are just some things that we see going on as we hope to start to emerge from the pandemic. I know certainly, there's at least some light at the end of the tunnel. But one of the things that we've been talking about a lot over the last year was the CARES Act. The CARES Act was part of this $10 trillion massive stimulus program that allowed a number of things to happen, basically to help participants and to help individuals get through the global pandemic. Prior to the CARES Act, there was something called the Secure Act that was passed, and the Secure Act really kind of created a number of different opportunities for participants and for retirement plans specifically around reducing fiduciary responsibility with things like guaranteed income products, breaking down some of the barriers that traditionally were part of these guaranteed income products, more of a focus on participant education and advice. We're starting to see kind of the theme here is defined contribution, 403b, 401k plans are starting to kind of shift. If you think about kind of this pendulum shift where, really 30 years ago, when it was really just a defined benefit world and everyone was focused on what's my retirement income going to be, that shift really kind of gravitated more towards and almost exclusively towards, well, what's my benefit going to be, or what's my accumulated balance going to be? So, for years, people would just think exclusively of, what's my 403b balance without really knowing what that would mean from an income perspective. We're starting to see that pendulum kind of swing back more towards the middle, which frankly is probably where it should be, which is, yeah, we still want to focus on this shared responsibility of participants contributing to their 403b plans, balances accumulating in these 403b plans, but we do need people to understand what that means from an income perspective. And part of that certainly is education and advice around this whole decumulation process, knowing how much Social Security is going to provide, what the required, what's required from a distribution amount to meet expenses. Does it make sense to lock into some type of guaranteed income product? If so, what's the right choice? And so these are all things that we're seeing in terms of trends in the retirement world. And I have no doubt that we're going to be continuing to talk about this down the road. Having your plan with TIA is unique in that there's always been this decumulation component to TIA via the TIA traditional. And we expect that, that decumulation, if you will, is going to continue to evolve and hopefully, really meet the needs of participants. So just wanted to spend a few minutes on this because I do believe that, in the quarters and certainly years to come, we're going to be talking a lot more about this whole concept of decumulation and how do we help participants make good decisions around how to take their money out of retirement plans. Jumping ahead to page 6, and kind of keeping on this same thing, I'm sorry, page 13, and kind of keeping on this same theme with some additional fiduciary updates. The DOL has actually provided some assumptions around what should be used when showing people what their projected monthly benefit will be. So again, a lot of companies have put this kind of potential future value right on their websites, right on participant statements. The DOL is basically now saying, let's put some structure around how these projections should be done. And that's described in the upper left-hand corner. We talked several months ago, but there is a new qualified birth and adoption distribution opportunity with retirement plans that's described in the right hand. And then down in the bottom, just pointing out that the CARES Act is starting to wind down. And in fact, parts of the CARES Act really have completely wound down at this point. And again, just some updates from a fiduciary perspective that we wanted to keep kind of top of mind with people. And then finally, from a fiduciary management perspective, page 14 is really a page from our fiduciary training. And, you know, one thing that we've made very clear over the years is that we recognize that the University of Maine system plan is not subject to ERISA regulations, but we do believe that it's just a good, prudent, best practice to follow ERISA guidelines. One of those guidelines is fiduciary training. The DOL has started to kind of move up on their audit checklist this whole concept of fiduciary training. You know, is it done? How often is it done? What does it look like? We've distributed our version of fiduciary training. It's about a 30-minute online training session that we distributed through Tracy and her office to committee members. We encourage people to do that. Again, even though it technically isn't a requirement, we just think that it's a good, prudent, best practice to follow. In addition to that, from a documentation perspective, because so much about just, you know, good fiduciary practice is making sure that you have a process in place, making sure that you're following that process, making sure that you're documenting that process. So we've started to incorporate components of the fiduciary training right into each of these quarterly review packets, you know, as part of that process, and frankly, as part of the documentation of that process as well. So that's on page 14, as you can see. And then finally, on page 15, before we shift to markets, I did want to point out that we continue to see just an incredible amount of consolidation in the record-keeping world. And so when you look at on the left-hand side of this page, earlier this year, Mass Mutual, which was we view as a top 10 record keeper, decided to exit the business, and they're selling their record-keeping business to Empower. Also, earlier in this year, kind of in an unprecedented move, Vanguard, which really was we view as a top 5 record keeper, not only decided to exit the business, but they're selling their business to and basically a technology company based in India, not even a domestic record-keeping company. And again, you know, for a top 5 record keeper to exit the business, what this really shows you as you kind of read down this list of, you know, really significant companies exiting the record-keeping business is just how challenging it is, frankly, to make money in the record-keeping world. When you consider that we continue to have a downward push on expenses. So the expectation is that plan assets grow. We're going to continue to see fees come down. We believe that's appropriate to consider that. But in addition to that, there's more and more pressure on things like technology and specifically cybersecurity. So you have this kind of increase in terms of demands, if you will, and this decrease from a fee perspective. And it's really creating this environment where it's very challenging for companies to make money in the record-keeping business. There's, in my opinion, I think Barry would probably agree, that there's really what I would consider to be a handful of companies that if you said, look down the road 10 years and tell me which companies you absolutely think will be in the record-keeping business. You know, it's a short list, but certainly TIAA, I would put, you know, towards the top of that list. They certainly are a leader. They have the scale that's required. They have the systems that are required. They certainly have the technology that's required. So I say this on one hand to just let you know what's going on in the record-keeping world, but also that we have complete confidence in your record keeper, in this particular case, TIAA, and that they continue to be committed to the record keeping world as well. And then on the next page, page 16, you know, part of the challenge that we're seeing is how difficult it is to operate in what is a historically low interest rate environment. And this is really connected to kind of my previous statement about the difficulty of making money in the record keeping world, where obviously, I think as everyone on this call knows, we are in a historically low interest rate environment. That's part of the fiscal stimulus, you know, that really has been put in place. The Fed is committed to keeping interest rates low. The theory there is they want mortgage rates to be low to encourage people to, you know, take out mortgages and refinance. Credit card interest rates to be low, to really encourage people in what is largely an economy based on consumer spending, you know, to continue to be able to spend money. So there's certainly some good things about being in a low interest rate environment. The challenge, though, obviously, is in the financial services world for organizations like banks to make money. But in addition to that, one of the things that Barry's going to talk about in a few minutes is the fact that money market yields are in many cases right now zero. In the case of the TIA money market, the only reason it's not a negative yield is because TIA has waived the expense ratio in 2020, and that's going to change in 2021, and likely we will see negative yields on that specific and probably other money markets. So Barry's going to talk about some actions that we have already taken to help with this, but then also that we can take moving forward to continue to help with this. But again, this low interest rate environment that we're in, there certainly is no sign that it's going to change anytime soon. I think we're going to continue to be looking at this historically low interest rate environment for the foreseeable future. And so jumping ahead to page 18, this is where those comments then lead up to just our general market commentary. And one of the things that I talked about is the fact that we have had historic levels of monetary and fiscal stimulus, over $10 trillion. In addition to that, the stimulus programs, which kind of taking a playbook out of the last financial crisis, were rolled out much more rapidly this time around, and really had a much more immediate effect on markets. And again, I think it's important to note, the difference between the overall economy and markets. They're very different things, but certainly the impact of those stimulus has been to help markets recover significantly. If for people who may recall at the first quarter that review that closed March 31st, we were talking about the S&P 500 being down over 30% at one point in March. And then you look on this chart in front of you, and you can see U.S. stocks, that's the S&P 500, up over 5.5% on a year-to-date basis through September 30th. That number through the close of business on Friday was actually positive over 14%. So just think about the S&P 500 recovery from 30% down to back positive to now here we are, at the beginning of December, up over 14%. That is literally historically fast in terms of the recovery. And again, a lot of that really does have to do with those historic levels of stimulus that we saw. In addition to that, international equities, you can see down 7% as of the close of September. Your core international fund, which is the American Fund's Euro-Pacific Growth Fund, through Friday was up a little over 18%. And bonds obviously having a very strong year as well. One of the nice things about your plan that I didn't talk about, I think one of the strengths of your plan is the fact that you do offer also that TIA traditional as part of your plan. So as we think back to that low interest rate environment that we're in, and the inability really for participants to make virtually any money at all on money market accounts, many of your participants are, sitting in a fixed account, which in some cases paying 4 or 4.5% yield, with guaranteed yields of, again, 3% as well. So again, I think that your plan, even when you look at kind of the weak aspects of the overall market, your plan has really done a good job, in terms of covering those areas very well. The next page is where I wanted to spend a little bit of time, though, on page 19, though, because as I mentioned, we do have a couple of fund performance issues, and I think this page 19 will help to tee up, some of Barry's comments around the underperforming funds specifically. And what you can see here, much like last quarter, is that the market recovery has been certainly very uneven, I think is one way we could put it. But when you look at the difference between growth stocks and value stocks, kind of at the middle bottom of this chart, what you can see is that clearly this has been a growth-oriented rally with large cap growth up over 24% relative to value at minus 11% through September 30th. Now, those numbers have actually improved since then, but we continue to see this dramatic spread between growth and value. Nowhere is it more dramatic than in small cap, where you can see as of the close of the quarter, small cap value down 21%, the worst performing asset class relative to growth, small cap growth, I should say, at about 4%. So we continue to see this growth-oriented rally. And the way that we look at it is, if you're managing money in the UMS retirement plan, if you're a fund manager, the more you've kind of leaned into growth, the more you've been rewarded. The larger you've stayed, the more you've been rewarded as well. And conversely, some really good funds that have kind of a growth at a reasonable price philosophy, or funds that maybe really lean into the deep value or value in general, are the ones that unfortunately have been penalized. We do expect to see eventually more of a rotation back to value. So we do expect it at some point to see this rotation back. But to be frank, we have been waiting for this rotation back to value for the better part of a decade now. Part of the dynamic of what we will have to see for that to happen is rising interest rates. And again, we really view us as operating in a low interest rate environment for the foreseeable future. Just to put it in perspective, just to put it in terms of the UMaine system plan, your large cap value fund, which is a John Hancock disciplined value, on a year-to-date basis is operating down in the 50th percentile. So again, it's kind of a middle of the road fund from a performance perspective, and that's at basically through Friday losing about 1%. So it's negative 82 basis points on a year-to-date basis. You contrast that with the Harbor Capital Appreciation, which is what we view as your core large cap growth fund. Through Friday, that fund is up over 47.5% on a year-to-date basis. Now, that fund is operating in the top decile, so certainly it's one of the strongest large cap growth funds on the market. So we understand that contrast, but even with that, I think it's just remarkable to see. It is one of the reasons, again, going back to why we think participant advice, or good solid participant advice, is so important, is that, if you consider a participant who is going through an asset allocation process and saying, okay, I want a certain percentage of my portfolio to be dedicated to large cap domestic equity, generally speaking, you want to see a split between growth and value. And so while you're getting some lagging performance in the value space, you're certainly getting really significantly solid performance in the growth space. So this theme of kind of growth versus value, funds that have kind of leaned growth being rewarded, funds that have been more value oriented, really getting harmed, is something that I know Barry's going to talk in a lot more detail about in just a few minutes. Page 20 is where you can see the asset class, the sector performance, I should say, with the S&P. And as you can see here, we really have been, this market really has been driven by a couple things. One is technology stocks, and specifically large technology stocks have done incredibly well. As you can see on the left-hand side, consumer discretionary has been a very, very strong sector in the S&P. That appears to look like it's going to continue as we're looking at now historic levels of online spending over the last few days. And then traditional value sectors like financial services and energy, you can see the worst performing asset classes. So all of these things, again, kind of explain that whole growth versus value phenomenon that we're seeing. And then finally on page 22 is where we try to wrap things up with a little bit of forward-looking commentary, with the understanding that, like everyone else, we certainly don't have a crystal ball, but we certainly do view, try to look forward to things that are going to impact the markets, impact the economy. And from a headwinds perspective, the first bullet remains the same as the last 2 quarters, and that is that the virus threat persists. And, frankly, the path of the economy, global economy, US economy, is really just going to continue to follow the path of the virus. And certainly, we love the fact that there's some light at the end of the tunnel. There's some great news coming out almost daily from a vaccine perspective, but that news obviously is in sharp contrast to what we're seeing from a virus perspective in terms of the number of people with the virus. And sadly, as my wife just pointed out to me this morning, the record-setting number of deaths here in the state of Maine as of today as well. So, we're certainly not out of the woods, and the overall economy is going to continue to follow that path of the virus. Our chief investment officer really describes it as I think appropriately being in a grind right now. So from an overall economic perspective, we've certainly gotten some stabilization, but we really view this as being a long grind in terms of the overall economy. And then from a tailwind perspective, again, the fact that the Fed certainly continues to be committed to doing what they can to really try to boost the markets, boost the economy, try to stabilize things as we do hopefully turn the corner with the vaccines and start to get back to more normal times. I think that there's really a kind of a school of thought out there from an economic recovery perspective that if you look at an economy that's 70% driven by consumer spending here in the US, there's certainly a lot of pent up spending aggression, if you will, for people who want to go out and go out to dinner, for example, go to retail stores, do things like that. And so the hope is that if we can just maintain some type of stability, kind of grind it out until we hopefully have a very effective vaccine being distributed, then we're I think likely to see true economic recovery at that point. And I'm going to pause there. I'm going to skip over the next several slides and hand it over to Barry, but I did first want to pause and just see if there are any questions at all on anything that I covered from a kind of a topical spotlight perspective or a market commentary perspective. Okay, and so Barry, yes.
Mike, Sven Bartholomew. Quick question for you, and this is, as the CARES Act monies begin to burn out on December 31st, should we be shifting some of our holdings to mitigate some of the pain of the pandemic as the pain of the pandemic really begins to reconcile through the economy? There's a lot held in a neutral position by the flood of cash, this, as you were calling it, historic levels of stimulus. But as of January 1, barring some massive undertaking at the federal level, we're going to see some of this really begin to come to fruition. And I just was curious on your take on that, Mike.
Yeah, I mean, that's the challenge. Actually, I would argue the challenge and the benefit to participant-directed plans like the 403B plan right now is that, all we can do as fiduciaries, as advisors, as members of the investment committee, all we can do is hopefully structure a retirement plan that gives participants adequate choices. And then to a large degree, we're really relying on the participants to make good decisions around what they do with those choices. So I think that that's one of the real challenges. Your plan, as we went back to the early days of the pandemic, one of the things we looked at is, was there a lot of money movement? Were participants shifting money, for example? Typically what happens in times of financial crisis is that participants will panic. They'll get out of equities, go into fixed income, and then sit there until they feel like the market has recovered and get back in the market. As you know, exactly the opposite of what participants should be doing. And that's why we have always really promoted, staying invested, staying the course. And that's largely what your participants did in the UMS retirement plan. And the benefit to that is that while they did see certainly a downturn in the early stages, they also benefited from the historic recovery levels. So, here again, I think that when you look at this plan specifically, all we can really do is offer the participants what we believe are really good choices. And then to a degree, we're relying on participants and hopefully the advice providers, whether they're advice providers that they have on their own or that they get through TIAA to give them some good guidance. That was a long-winded non-answer, I think, in a lot of ways, but it's kind of the reality of defined contribution participant-directed plans.
Yeah, thanks, Mike. And I was thinking almost more broadly, just in terms of the several portfolios we have invested, as much as our participants.
Yeah, this is Barry. When when I take over the reins here in a couple minutes, I think we do have a lens into, because of the Fed action, and they've already foretold that they're going to keep interest rates low for an extended period of time. We have a couple funds that we're going to talk about today that are very deep value focused, and understanding that while the pendulum may have swung a little bit too far on value, it's still going to be a growth driven market, especially with a low interest rate environment. Think financial services companies. So I think we're using that lens when we're looking at a couple of these fund change recommendations, perhaps to look at managers that are less deep value, that managers are more relative value, that they can maneuver in what's a very challenging market. You want me to take over, Mike?
Yep, I think it's all you, Barry.
Okay, great. If we look on page 31, this is just a snapshot of the assets per plan, a little less than 1.7 billion as of the end of September. The one interesting thing, as you all recall, for those who have been here a while, you used to have 4 record keepers, and we made the decision probably about 7 or 8 years ago to go to a single record keeper, TIAA. There are still about $40 million of assets sitting at the 3 former record keepers. So we do think longer term, we ought to be thinking about a strategy to encourage some of the movement to what's a more monitored fund menu, less expensive fund menu. But it is something that we see over time. Participants have moved some money, but we do think there's probably some strategies we can put in place to accelerate some of that movement to TIAA as the single record keeper. This might be a little hard to see, so I apologize if you move your face up to the camera. I totally get it, because that's probably me as well. But what we wanted to show you, this is just a graphical display. Since you have so many plans and different funds, we're just trying to show you a combined kind of asset level based on each particular fund and each particular plan. A couple things I'm going to point out here is, TIAA traditional, if you look 3/4 of the way down, I'll put my arrow here. That's still the largest holding, about almost 31.5%, as Mike had talked about, in this low interest rate environment. For those participants that have been fearful, of the market itself, that it's a safe haven for them. Some of those vintages are paying 4 or 5%. So we do think that's certainly an appropriate vehicle for participants, especially as they get closer to retirement, where capital preservation is really, really paramount to them. Moving up, the second largest holding is CREF stock at about little less than 14.5%. TIA used to, when they engaged advice with each of your faculty and staff member participants, they tended to use TIA traditional, CREF stock, and then perhaps a little bit of TIA real estate. So in most of the plans that we see, these two are the largest holdings, but that number is coming down over time. And the reason that's coming down over time, if you look midway down, you see where my arrow is, the Vanguard Target Retirement Funds. Remember, these are our target date funds. These are the default vehicle. If somebody doesn't make a decision, they go into those funds. Those are based on retirement date, so they become less aggressive over time in the early years, upwards of 90% equities, down towards the latter part, kind of post-retirement, down to about 40% equities. That number, you can see it's about 12.5%. That incrementally will continue to grow over time. We think that's really the most appropriate vehicle for upwards of 75 to 80% of your faculty and staff members. It's a set it and forget it. Let the allocation kind of wind down over time and become less aggressive. And so those 3 are the largest holdings by far. And I think the next largest holdings is about 4% or so. The funds we're going to talk about today, there's 3 funds in particular we want to talk about. The first is the CREF Money Market Fund. You'll notice that's about 4 lines down, about $48 million. Part of that money is in legacy contracts, which we cannot control. Part of that money is in the new contracts that we converted to earlier this year that we can control. So we're going to talk about CREF Money Market. The next one is the DFA Emerging Markets Core Equity. If you look down, it's about 1.1% of the assets. You can see where my arrow is. Yeah, that's a fund, emerging markets. It's got a value bias, so we're going to talk about that fund. And then the John Hancock Disciplined Value Fund, a little less than 1.5% of the assets, about $23.6 million, a deep value large cap, U.S. large cap value manager. Those are the three funds that we're going to talk to more in depth. So let me just go to the scoring, which is found on page 47. Excuse me, 49, sorry. And for just as a quick reminder, remember this is it's a 100-point scale. Each of these individual categories have a particular scoring metric. So we look at risk-adjusted returns, 3 and 5 year, more punitive for 5-year underperformance, peer relative performance, 3 and 5 years, style, they stick into their style, again, 3 and 5 year, confidence rating, which is simply information ratio. We're measuring the volatility of excess returns. Our preference is to have a more consistent manager, not hitting a grand slam one quarter and then striking out for the next 5 quarters. So this is just a measure of consistency. That represents 70% of our scoring, and then fund management is 25%. Our forward-looking views of the management team, the management structure, how they're sourcing ideas, and really getting an assessment of whether this process is repeatable or not. And then fund firm is 5 points, really more of a placeholder. If like Roger Ferguson, as you all may have seen, made the decision to leave TIA at the end of March. Well, that may not affect how TIA manages particular funds. It's a lens into perhaps somebody coming in that might have a different view and how are they going to steal the ship in a longer term basis. So really just gives us an idea to a mechanism for us to look at that more at a holistic level. So as long as the fund is scoring an 80, it's in good standing. You see John Hancock Disciplined Value is scoring a 76. We're going to talk about that particular fund. You have many funds that are scoring a 100. And in order to score a 100, these managers have to be in the top quartile of every box across the board. So you can see on this page 4 funds that are scoring 100. You go to the next page, you got another fund that's scoring a 100. Caroline Eagle Small Cap Growth, that is not a fund we're going to talk about today unless somebody has any particular questions. This is a fund that's been kind of on the radar, but as we continue to see their performance, this is really a 2019 underperformance issue. When we looked at performance through the end of September, they're beating their benchmark in every period measured. So if trends continue, this fund will be meeting policy guidelines, we think, by the next review cycle. So we're encouraged by that one. We're going to talk about DFA Emerging Markets. That's now scoring a 67. And then we're going to talk about CREF Money Market. The Vanguard Target Retirement Funds are scoring a 94. Again, this is our default vehicle. We spend time on this one. These are very low cost index constructed. Vanguard calls them active allocation. They simply use index funds to actively allocate across the various vintages. But Vanguard's clearly a top performer, one of the top 2 or 3 target date funds in the country. So I wanted to really spend time to get to the 3 other funds. You can see all the other funds are meeting policy guidelines. The index funds, as long as they have a low fee and they're tracking their index, they're going to score green, which again, we're at Vanguard, one of the top index fund managers in the world. We also have CREF Stock and TIA Real Estate. These are distinct investments because there's not really an index by which to evaluate them. And both funds are performing based on what we believe are sound performance. I mean, you look at TI Real Estate where they're invested in hard real estate, commercial real estate. It's very unique. It's a good hedge against inflationary pressures. But overall, those 2 funds are scoring green in our scoring system. So I'm going to stop there because I want to spend time on the 3 funds that in particular that we want to talk about, which is CREF Money Market, DFA Emerging Markets, and John Hancock Disciplined Value. Before I move on to those 3, are there any questions regards of performance, anything up until, again, these 3 funds we want to dive into further. All right, hearing none, I'm going to move to page 100. The first is CREF Money Market, and as Mike explained, this is a variable annuity, and because it's a variable annuity, TIAA simply cannot waive this fee. They have a 23 basis point fee, and what they had to do is go to the New York State Insurance Commissioner, which is now called the Department of Financial Services, and petition to get a fee waiver. As Mike just explained, we're in the historically low interest rate environment. And as a result of that, most money market funds are yielding, if anything, single digit yields. Unlike a mutual fund, the Vanguard Federal Money Market is a mutual fund, and mutual funds by prospectus have the ability to waive their fee over extended period of time. So this is not an issue with respect to Vanguard Federal Money Market, but it is on CREF Money Market in the sense that the Department of Financial Services only gave the fee waiver through the end of December. So if you think about beginning January 1st, unless something happens between now and the end of the year, and Fed Chairman Powell does something where we don't see what he would do, but it is highly likely that the CREF Money Market Fund, because of that 23 basis point fee that they're going to reinstate January 1st, this fund will start experiencing negative returns. We don't think that's good. It's certainly not a good outcome for those participants that are thinking about capital preservation. Whereas Vanguard Federal Money Market, again, it has a lower fee at 11 basis points, but even if their rate got down to 0, they can waive that fee indefinitely. So as a result of that, Vanguard Federal Money Market is already a available fund option across the system. Because of this low interest rate environment, because of the fee waiver going away at the beginning of January, our recommendation is whatever assets that are in CREF Money Market that can be mapped. And what I mean by that is when we migrated to the new contracts in March of this year, we now have institutional control over future assets in this particular fund. So since March, when we made the switch over to the new contracts, we as a committee have the ability to move those assets into a different fund. So our recommendation is to whatever assets we can move that are institutionally controlled in CREF Money Market, I think it's about $20 million, into the Vanguard Federal Money Market Fund. So that's accumulations, again, accumulations from March forward, as well as future contributions into the Vanguard Federal Money Market Fund. So I'm going to stop there for questions. And I don't know if you want me to do all 3 and then make it as one kind of one sole recommendation, or do we want to do each 3 at the same time, each 3 independently?
Go with whatever you think is best, Barry.
I'd like to just do them as we go. That way we've taken care of that and we can move on to the next one. So again, our recommendation is to, for those dollars that we have institutional control of for CREF Money Market, close and map those assets to the Vanguard Federal Money Market Fund, and that includes future contributions.
So what you're asking, Barry, then is to move any funds that are going to be in those negative returns, get them out of there, transfer them over to something without a negative return.
Yeah, and we can't move all of it. TIAA is sending out a letter to participants. I think it's going out this week or next, informing participants of this situation. But because we don't, prior to this conversion to these new contracts, the individual retained control of those assets. So we don't have an ability to move all 40-some million dollars. Again, I think it's about $20 million that we can move that this committee has institutional control over.
And maybe we should notify participants that they should be aware of this as well.
I think the communication, maybe we can be a little more direct, saying, hey, you also may have assets that we can't control and consider moving that as well. Yeah, so I think we could work with TIA and on that communication as part of the fund change.
Yep.
Chair? Kelly?
Go ahead, Mark.
Yeah, I just want to echo Sev's comment. I think it's very important. It makes a lot of sense to do this, but I think it's very important that there's clear, concise communications. I'm not sure who does it to the participants so that they really understand why things are being moved and it may be out of their control or seem like it's out of their control. And we've learned recently how important communications really are.
Barry, perhaps you, Tia, and myself can work on that, and
Yes.
With HR is appropriate as well.
Yeah, we will work with, once, let's assume you make the decision to make these fund changes that we're talking about today, we have to get into the queue with TIAA and they'll pick us a date and time. It's probably going to be, at this point, probably February before this would actually move, but they will have a communication and we'll work with Tracy and her team in developing a more custom and probably more direct communication, especially as it relates to this particular fund.
Barry, this is Kelly. I know we talked about this a little bit, but is there anything other than a letter? Is there such thing as would TIAA do seminars or anything of that nature, or offer times that people could call in? I worry about
Kelly.
letters.
I think that's a good idea, even if they had a webinar specifically as it relates to money market. I think that's a good approach. We'll ask.
I know a lot of, being in the business, a lot of letters that are sent out are, it gets mixed in the prospectus, no goods pile,
And Barry, if you have maybe a one-page or a short piece on this that I could share with our labor connections, and they can make sure the unions are aware of this so that it doesn't catch them by surprise.
Yeah, we've been working on some custom communications for clients that have all the legacy contracts. So yeah, we can send you a sample kind of communication on that one, and we can tweak it.
Thank you.
So I made the recommendation.
Okay, so we want to make separate.
Yeah.
Okay, so I'll read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the following defined contribution plan fund changes: close the CREF Money Market Fund and map both future contributions and eligible accumulations into the Vanguard Federal Money Market Fund. Do I have a motion?
So moved.
Moved by Trustee Bartholomew. Do I have a second?
Trustee Martin?
Yes.
I believe our resolution includes all three, not separate action items.
That's fine. Okay.
So we need to. Okay.
Okay,
right.
that's fine.
We'll have to wait until Barry reviews all three, and then we can take action.
Okay. Thank
Apologies.
you.
Okay. So the next one is the DFA Emerging Markets Fund. Again, this has about $18 million, 1.1% of the assets in the various plans. And as Mike had talked about in his market commentary, this particular manager is a value bias manager in a market that hasn't rewarded value managers. When you look at this particular manager, not only does it have value, it has significant exposure to small cap value. And so you think about that, you would expect this manager to underperform based on the current market. But our concern is their strategy in such a low interest rate environment for the foreseeable future. We have less confidence that this manager can adapt to what's a changing marketplace going forward. So our recommendation is for this one is to replace it with the American Century Emerging Markets Fund. We also showed you an index fund. So if the committee felt like, gosh, we should just have exposure and cut the expense, we are showing you the Vanguard Emerging Markets Fund. However, when you look at particular asset classes, this particular asset class has rewarded active managers. So you can see American Century from a performance perspective have outperformed the index rather significantly over long periods of time. So we do believe this is a particular asset class where active management has benefited, even though we have a premium, obviously 90 basis points versus 14. American Century is an all cap manager, so it does have exposure to small cap, mid cap, and large cap. It's more kind of momentum based. It does have a little bit of a growth tilt to it. And so when we look at this particular manager, you can see over time it's done quite well vis-a-vis the DFA fund. Even in down markets, it's held its own. You look at 2015, 2014, a little bit underperformance in 2018 relative to the benchmark. But at the same time, they have a deep analyst team, spent a lot of time in China. In fact, one of their analysts used to live in China and has a lot of ties into the Chinese marketplace. So we do think that adds a little bit of an edge. And so when we look at this, considering where we are in such a low interest rate environment, that growth, while the pendulum might swing back to value for a short period of time, we don't think that it's going to be a long period of time where growth continues to be in play. So when we look at this kind of net, we just think a manager that perhaps has a more growth tilt for the foreseeable future is probably a better play in this particular space. You can see, other numbers. We look at manager tenure. We look at average market cap. You can see they're at 45 billion. So clearly more mid-large cap kind of driven, as opposed to DFA at about 14 billion in market cap. So our recommendation is to replace the DFA Emerging Markets Core Equity with the American Century Emerging Markets R6 Fund. Expense is obviously something that's a consideration, 48 versus 90. So we are significantly increasing the expense, but remember, these returns are net of expense. And you can see on the far right, the average for the emerging markets universe is 1.45. So they're certainly below the median from an expense perspective, but a lot more expensive than DFA.
Barry, why don't you tell me that one more time? So expenses twice, but return is far greater. Is that what you're saying?
Yeah, if you look at the return, you see like the quarter 12.82 versus 8.48. Those are net of the expense. The expense is taken out. So even though American Century has a 50 or 42 basis point more in expense, they've added significantly more value.
And this is more of a growth-oriented
manager? Yes.
Okay.
Yeah.
Thank you.
And that's where we just look at this market and saying, while value might, it swung back a little bit in October, perhaps a little bit in November, sustained low interest rate environment tends to favor more growth-oriented funds. Any questions before I move on to the third? All right, having heard none. The third one is the John Hancock Discipline Value. Again, these are same themes, so you'll understand kind of how we're thinking about things. The John Hancock Discipline Value, the manager is Robeco Boston Partners. It's sub-advised by them. They are a deep value, kind of bottom-up traditional value manager. And when you look at their performance, again, we would expect their performance to be hurt based on their particular strategy. Our concern, like DFA in this particular manager's case, is a deep value manager in a low interest rate environment that really, I mean, we appreciate the fact that it's stuck to its knitting, it's stuck to its process, it hasn't changed its process, but is that process going to reap the benefits over the foreseeable future? And so when we look at alternatives, JP Morgan is our recommendation. They are more of a relative value manager. They do have exposure to some growth oriented securities, certainly a lot less expense. And what we really like about JP Morgan, if you look at the calendar year performance kind of midway down, their performance is very consistent against the index and against its peers. But when you look at kind of the cumulative performance, annualized performance on 1, 3, 5, and 10, they have done exceptionally well over what's been really a challenging decade or so of market experience. And we just, when we look at this, we like MFS. So MFS is also a one of our high conviction names. We give the edge to JP Morgan. It's very consistent, and their performance has just been really, really good, and again over challenging markets for the last 10 years. And so that's kind of like the same thing at DFA. Is here's a John Hancock. Again, we appreciate their consistency of how they approach their process, but their process, our concern is their process going to continue to generate less than stellar performance results in the foreseeable future. And our feeling is yes, relative to other managers that are more relative value. So our recommendation is the JP Morgan fund. You can see about 21 basis points less expensive too. So that doesn't hurt. Long tenure manager, Claire Hart's been there at the helm for a long period of time and has just done really, really well. So that would be our recommendation.
Okay. Is that it, Barry?
That is it. Yes.
Okay. Well, I want to thank you guys for your informative market review and fund review, and thanks. We appreciate your guidance, and that moves us over to a proposed resolution. So I will read the text of the proposed resolution: that the Board of Trustees, acting through the Investment Committee, approves the following defined contribution plan fund changes: close the CREF Money Market Fund and map both future contributions and eligible accumulations into the Vanguard Federal Money Market Fund. Number 2 would be replace DFA Emerging Markets Fund with the American Century Emerging Markets Fund. And the third would be replace John Hancock Disciplined Value Fund with the JP Morgan Equity Income Fund. Can I have a motion?
So moved, Kelly.
Moved by Trustee Bartholomew, second.
Seconded.
Seconded by Trustee Gardner. And Ellen will take the roll call for the vote. Thanks, Ellen.
Certainly. Barry, could you end your share screen? Thank you. Trustee Bartholomew.
Yes.
Trustee Irwin.
Yes.
Trustee Gardner.
Yes.
Trustee Eustace.
Yes.
Trustee Martin.
Yes.
The motion is carried.
Great. So on to tab 4. I'm going to turn the floor over to NEPC, Kelly, Regan, and Jay Rooney, for performance reviews of the management investment pool, defined benefit pension, and operating fund portfolios.
Hi, Kelly.
Thank you all.
Good morning.
How is everyone doing today?
Good.
Good. I hope you all had a great Thanksgiving. Hopefully you can see my colleague Jay Rooney on video as well. So both of us today are going to walk through markets and performance. We do have one recommendation for the committee that we'll get to regarding a manager, GMO, and the GAA, our global asset allocation. But Jay and I are really pleased to be with all of you today. And I think as we walk through the report, you'll see a couple things. One, we've certainly had strong market performance through the third quarter, as you probably just heard from Cap Trust. So we will walk through that and mention a couple items because we did also have a very strong November in markets with some quite stellar returns from indices across the globe. And then when you look at performance, and we have Q3 performance here for all three of the portfolios, Jay and I are really pleased to see that all three portfolios did very well. Managers across the board are doing very well. There's really only one that we have concern with at this point in time, which we'll talk about later. And as we look through October and November performance, and I do some estimates on the portfolios, this calendar year to date for all three portfolios has been quite strong. Both the MIP and the pension are estimated to be up about 10%, and the operating funds estimated to be up about 5%. So I think we have a lot of good news with the committee to share today, both on an absolute and relative basis, and then again, one recommendation. So with that, I'm going to share my screen and see. Can you all see it? Okay, I'm seeing thumbs ups and nods. So I'll turn it over to Jay to start with the market overview, and then I'll take it back when we talk about performance for the portfolios. Jay, we can't hear you.
There, is that better?
That's
much better. Okay, I'm sorry. I deal with so many different systems. It's hard to keep track of one versus the other. But good morning, everybody. Kelly, thank you for that introduction. As she mentioned, we're very pleased to be here today. I'm only going to cover 3 or 4 pages in the market review session, thinking that Cap Trust really did a great job. When I looked through the materials, it looked very fulsome. But I did want to drive a couple of points home, and that's first can be seen on page 122. And suffice it to say, regardless of what you invested in, or regardless of what your strategy was, chances are you did quite well. You know, on the equity side in the upper right, you see returns in the mid to high single digits, and on the fixed income space in the lower left, you also see strong returns in the low to mid single digits. And the more credit risk you took, the higher returns you received during this time period. But if you turn to 123, I'll get just a little bit more granular. And this shows the performance of the markets through the month of September for the quarter and year-to-date time period, if you look at those first 2 columns. Now, I'm not going to specifically go through the year-to-date numbers, but what I want to do is verbally tell you how those markets have done through the end of November. And depending upon what metrics you look at, the markets during November were really the strongest markets since 1987. So again, we had an incredible market run during the month of November. So I'm going to go down about 6 or 7 indices, giving you the year-to-date numbers through the month of November. The S&P, which is in that first row, is actually up 14% year-to-date. That's quite a difference between the 5.6% return year-to-date through September. If you go down to the EFI index, which is the international developed, you kind of see that negative 7.1. It's now positive 3%. Emerging markets is an even better story, 1 row down, up 10.2% year-to-date. And fixed income, not to be left out, if you go down to that Barclays aggregate, which is the first row under domestic fixed income, it's actually 7.4% return. And the credit markets have rebounded quite dramatically. You see high yield bonds, which is 3 rows down, up an amazing 5.1. And emerging market debt, not to be left out, in the second row under global fixed income benchmarks, is not down negative 6.3. It's only down 80 basis points. So again, incredible returns, particularly during the month of November, and that's going to dramatically affect how your 3 portfolios have performed, and Kelly has some estimates for you. One thing I would like to mention, and you know, I know Cap Trust talked about value versus growth markets, but there has been a rotation in the markets in the last month and a half, 2 months. Value has done better than growth, you know, during the most recent time period. Small cap better than large cap, and international and emerging markets really better than the S&P 500. So we're seeing a rotation from what's worked for the last decade to what's working currently. The big question is that going to continue? And nobody really knows. Kelly, if you turn to page 126, I just wanted to highlight, you know, a couple of interesting charts that you can dig further into if you have spare time after the meeting. But what really drove the S&P 500 were 6 stocks. And you can see the performance of those 6 stocks highlighted in green versus the S&P 500, which is in blue. And those 6 stocks were Facebook, Amazon, Apple, Netflix, Google, and Microsoft. So it was a really focused market we've seen more recently that drove things. But if you turn to page 127, just the next page, you see how the performance of those 6 stocks have really skewed the markets quite dramatically. As you can tell by looking at that first bar over to the extreme left, those 6 stocks have a market cap of over $7 trillion in assets. And for comparison's sake, if you take a look at the bar to the immediate right, you see the Russell 2500, which is all the small cap stocks here in the United States and all the mid cap stocks here in the United States. That market cap of those 6 stocks dwarf almost the whole rest of the market. In fact, it has a market cap almost as high as European stocks at this point in time. So again, there is a rotation going on, but I think that those 6 stocks, even though they might be priced high or they might not, probably have a lot of legs left in them because technology is what's really driving the markets and the way people are living today. So again, you can't ignore those, but there is an interesting rotation in the market currently. That's all the prepared comments that I did have on the markets. There are some interesting facts about how spreads have compressed and what's going to propel the market to the next stage. But you've seen a lot of that already. Everything has to do about the virus trajectory and the vaccine coming out. There is one comment that I would like to make. Actually, I'll go back on my words saying that was the last chart I was going to look at. Kelly, if you go back 1 page to this page right here, even though I think there's a lot of hope and a lot of good news in the markets occurring at this point in time, the amount of debt that's on our balance sheet at this point and the spending that's occurring in Washington because of this crisis is getting a little disheartening at this point in time. That said, debt on a balance sheet doesn't become a problem until somebody thinks it's a problem. And right now, you know, foreign investors are excited to get into the U.S. markets and to buy our debt. So again, just something to look at, and hopefully the politicians can get together and really figure out a solution to get our spending in line after the crisis abates. Any questions before I turn it over to the better news, which Kelly's going to report? Okay, not seeing any. Kelly, take it away.
Okay, great. Thank you, Jay. So we're going to start with performance for the managed investment pool, what we call the MIP. You can see, and this is as of September 30th, we had assets up around 370 million. Which is quite a big increase. It's almost 19 million increase since the last time we spoke to you. You can see that the managed investment pool continues to be diversified across a number of different asset classes. And then within those asset classes, there is still more diversification through the global asset allocation managers and hedge fund managers. And when you look at this asset allocation versus your investment policy statement, you're within policy ranges and close to policy targets. So the good news over here in the top right is plan performance. You can see for the quarter, the managed investment pool is up 6.1%, given that strong equity rally that Jay just walked you through. And when you look at that 6.1%, It's certainly nice on an absolute basis, but on a relative basis, when you think about all your active managers in aggregate and you compare them to passive benchmarks, that's your allocation index. And the difference there shows you if active managers have done a good job. And for this particular quarter, they have up 50 basis points. And you can see even over the year-to-date time period and the one-year time period, only trailing by 20 basis points. So the active managers, when we go through performance, you'll notice a number of them are really outperforming their benchmarks and really clawing back from some of that underperformance that we've talked about historically, as we've made a number of positive changes into the portfolio, hiring managers such as Walter Scott, J.O. Hambro, and given Mondrian some more time, your emerging market equity manager, as they've bounced back quite nicely. And then when you look at these absolute returns for the managed portfolio versus peers of similar size, you can see that you rank quite nice over the quarter, year to date, and 1 year time period. Over the quarter, you're in the top third, meaning your return was better than the majority of the peers. And then over the year to date and 1 year time period, you're ranking right around median of the peer group, which is nice to see. In terms of recent actions, we did do some rebalancing during the quarter for spending needs. And as I mentioned earlier, we do have one recommendation for the managed investment pool, which is to consider reducing the allocation to GAA, and Jay will talk about that later today. I should note, and I noted it in my opening comments, but for the month of October, this portfolio was down about 1%, as we did see risk assets decline. But for the month of November, I'm estimating a 10% 1 month return for this portfolio, bringing this year-to-date return up to about 10.5%, which is quite stellar for a year where we've seen a lot of volatility earlier in the year and what we're experiencing with the virus. If we look at the pension fund's a little bit more conservatively invested compared to the managed investment pool. It has less equities than the managed investment pool, but still was able to generate a good quarter of 4.2%. And comparing the returns to that allocation index, you can see managers in general in aggregate have done a nice job, 20 basis points of value. And then even over a year to date in 1 year, 3 year time period, this portfolio is now outperforming passive benchmarks. And some of that is due to the more conservative nature in the first quarter, where we did see this portfolio protect a little bit more on the downside when the virus did hit. In terms of asset allocation, again, very diversified. It looks like it may not be, because you have about 30% in this green section here, which is global equity. But remember, that's your manager, Walter Scott, that invests across US and international markets. So it is diversified. It's just with one manager that has more flexible mandate. And then in terms of assets, about 25.5 million. This was about $900,000 increase from the last time we spoke. And most of that, really all of that, is due to a contribution that was made later in the quarter for the pension fund, as you make annual contributions into this fund, given the funded status. But what was nice, though, is we saw investment gains for this portfolio really make up for any benefit payments that were paid during the quarter. And benefit payments run around $350,000 a month. So we did see investment gains of 1 million to really offset that, which is great to see. We don't have any recommendations for this fund today, and just recent actions. We always work with Tracy to rebalance so we can make those monthly benefit payments. On page 135, we have the operating fund. So about 311 million in assets, which is a sizable increase, about 40 million from the previous quarter. You do see inflows into this fund in August and September timeframe, given the start of the school year. In terms of performance for this plan, again, very nice performance over all time periods. The operating fund, you can see for the quarter, was up 2.1%, outperforming its allocation index or passive benchmark of 1.7. So 30 basis points of value add from a portfolio that really is heavily weighted to cash, around 30% in fixed income. So that's nice to see. And you can see over all time periods outperforming that passive benchmarks, which shows that you have a very good group of managers in this portfolio that over time together have been beating their respective benchmarks. I should note, and I'm going to flip back because I didn't mention it, but the pension fund for October was down 1%. And for November, it was up a little over 6% by our estimates. So again, we're estimating a calendar year-to-date return of about 10% for the pension fund. And then for the operating fund, this portfolio is estimated to be up about 2% in November, pretty flat in October. So we're estimating about a 5% calendar year-to-date return for the operating fund. So again, really nice, strong performance from markets, strong performance from managers, really has positioned these portfolios to do well on a calendar year-to-date basis, and your fiscal year-to-date's also off to a good start. I'm going to move in and talk about some of the investment managers. And the MIP and the pension use a lot of the same investment managers. So I'm just focusing on the MIPS managers, but a lot of these managers are within the pension fund too. And I'll call that out, but just in the interest of time, I just wanted to focus on the MIP to start. And what you can see here is, first off, in the quarter, if you just scroll your eyes down, you can see that all managers were positive during the quarter. And really, all managers, with the exception of 2, outperformed their respective benchmarks. You have both here in small cap, a growth manager with Westfield and a value manager with DFA, both outperforming their benchmarks during the quarter. Walter Scott's one of your newer managers, again, that global equity manager, off to a good start, outperforming their benchmark. And then within your EFI managers, or your international development managers, you have 2, Morgan Stanley and J.O. Hambro. Morgan Stanley's more value-based, and J.O. Hambro's a newer manager in the portfolio that has a little bit more of a growth tilt to it. And you can see, and this was a little bit what Cap Trust and even Jay was talking about in his market comments, the growth manager, J.O. Hambro, up 9% versus Morgan Stanley up 3.5%. So you can see that differential, even that we had in the US markets, occurs in the international markets as well. But over the long term, Morgan Stanley has been able to keep up with their benchmarks. And they're right in the middle of the pack when you look at them versus other value peers. And then Kabouter, again, a manager that's not gonna keep up with the benchmark when it's up 10%. It's not pure value, but it's a little bit more conservative. This is a manager that focuses a lot on ESG as well, but they did have nice returns during the quarter. And then you can see their year-to-date and one-year returns looking quite nice versus their benchmark, as they've added significant value there. One bright spot of this portfolio, and really for the quarter, is in your emerging market equity managers with Aberdeen and Mondrian here at the bottom. These are 2 managers that when we looked at them like 1-2 years ago, they were underperforming the benchmark, but they've both really bounced back. You can see Aberdeen and Mondrian both outperforming, and these numbers next to their performance are the ranks. So ranking in the top quartile of other emerging market equity managers that you could have selected from. So really doing a nice job there. And when you look at them over a year-to-date, 1 year, and even a 3-year time period, doing quite nice. So both of these managers we've talked a lot about, but sticking with them has proved to do well for the portfolio. And let me just mention that in the pension, I'm just going to switch back. You only have 2 of these managers, Walter Scott and Mondrian. And one of the reasons why we have less managers in the pension is due to the size of the pension, and we're able to get enough diversification because Walter Scott does do both US and international. Moving on to fixed income and alternative managers on this page here. In the fixed income space, if you look at the total fixed income line here in the top green, you can see over the quarter, all of your fixed income managers, if you combine them together, return 2.6%. So we have a portfolio here that's invested in core bonds through Common Fund, TIPS or Treasury inflation protected securities with Vanguard, some diversifying fixed income with BlackRock, and then some return-seeking fixed income through bank loans with Bain. And when you combine all those together, deviating away from just a traditional core Barclays aggregate benchmark, which is the main benchmark to invest fixed income assets, you can see about 2% of value add by diversifying the portfolio during the quarter. And when you look at that versus other fixed income diversified funds, that's in the top quartile there. And you can see over all time periods, some nice rankings for your total fixed income composite and some good returns versus the benchmark over select time periods. In terms of managers, Common Fund is one manager. When you look at it over the quarter, they did a great job, but some of their trailing performance over the year to date, 1 year and 3 year, is really driven by the underperformance they had in the first quarter. This particular manager invests more in credit than your traditional core bond managers, and that did fall short in the first quarter. So that is dragging down some of the returns. But you can see over the long term, still holding up quite nicely. And then within BlackRock and Bain, you can see some nice returns here versus their benchmarks and their peers. So your diversifying, more return-seeking fixed income has held up quite nice and really participated in the recent rally. Within global asset allocation, we have 2 managers in this portfolio. And let me just take a step back. So in fixed income, when you think about your pension plan, you have these 2 Vanguard managers, BlackRock and Bain. You index the common fund allocation in the pension plan. So there is that one difference between the pension fund. So your pension fund would be doing better over the year-to-date 1 year time period compared to the MIP, just because of that index exposure and not having the common fund falling short of its benchmark. Within GAA, here in the MIP, we have both GMO and Newton. In the pension fund, we just have Newton. And this is the manager that we're going to talk about a little bit later, is GMO. This is one manager that has been really focused on value-oriented equities, and specifically value-oriented international and emerging equities. And that has really been one of the main reasons why their performance has been underperforming over all time periods. And it's on a quite significant basis. Over this calendar year to date time period, we have about 11%, over the 1 year, about 11% of underperformance, and even more significant over the year-to-date performance. Now, I would hope to see that in October and November, they would bounce back. I don't have their actual results, but given that value markets have turned back, specifically international and emerging, I'll be looking to see if they were able to capture that performance. And then another thing about GMO is that, they were in this portfolio to protect on the downside. And they did that back in 2008. You've had this manager for a number of years. But when we look at their performance in the first quarter, and we would have expected them to protect on the downside, they didn't. So we're going to talk a little bit more about them later, but just wanted to point out their performance for you and how much it has lagged the benchmark on quite a significant basis. Newton, on the other hand, they have also lagged their benchmark. But when you look at them versus a peer group of other global asset allocation managers, you can see that their rankings are quite good, better than median in most cases. And you can also see that this particular manager has outperformed GMO. And Newton was even put into this portfolio to be more conservative, and they've really held up their ground. They're a hard manager to benchmark, so I wouldn't hold too much weight to the 60-40. I think over the long term, over a 3-5 year time period, we would expect this manager to outperform that. But over the shorter time periods, there will be deviation from it. But given other global asset allocation managers that you can invest in, they've really held up quite nicely. And then lastly, Lighthouse is your long-short equity hedge fund. And they've had some great performance versus benchmark, great performance versus peers. Even over the last 1 year time period, you can see up almost 17%, which is quite nice to see, given that they're not 100% exposed to the equity market. So they've been able to add a significant amount of value. I'll turn to the operating fund now. The operating fund, as I mentioned, is made up about 30% and a little overweight today, 40%, given the inflows, but made up of 4 different types of money market funds in the state pool, really earning nothing today, given where Federal Reserve Fund rates are and money market rates. And you can see that here from the performance. So we try to diversify away from cash, be conservative in nature, and do so. We start with the income pool, which is made up of 4 fixed income managers. You have your short-term, You have your diversifying BlackRock and Loomis bank loans like you do in the other two portfolios. And then you have your index core fixed income. And when you look at performance over the quarter, positive performance there. And when you look at, rankings over the year to date, 1 year time period, they've ranked, this group of managers has ranked quite nice versus peers. One of the managers that we're going to continue to monitor is Loomis Sales. So in the other two portfolios, you have Bain as your bank loan manager. Loomis Sales is more conservative than Bain, and that is why they remained in this operating fund and have been here a lot longer than Bain and the other portfolios. But you can see some disappointing performance over all time periods. A lot of this stemmed from Q1 when they did underperform the benchmark in that down market, and it's really gone through some of their trailing performance. So we're going to continue to watch them and their role in this portfolio. And then down in the total return composite, we've talked about a lot of these managers, Lighthouse, Newton, and you do have Vanguard, your global equity passive exposure. The other manager here that you don't see in the other two portfolios is PIMCO. And they have also had some struggles more recently over the year to date, 1 year time period, but you can see longer time periods, 3, 5, they've done a little bit better. And PIMCO is more, so I talked about GMO being more equity focused, Newton being more 60-40 focused. PIMCO really has very little exposure to equities. And when they do have exposure to equities today, it's all emerging market equities. They have a lot of diversifying exposures that you don't have in this portfolio, such as emerging market debt. They have a lot of inflation type sensitive exposure and things of that nature. So they do play a role in this portfolio. I would expect when we look at their performance for October and November, given the strong rally that we've seen in emerging markets, that this performance would look a lot different if we showed you performance through November. But no concerns with them. We like the role that they play in the portfolio. We like the role that they play with Newton in the portfolio and understand their performance. And then lastly, I have the due diligence monitor. So NAPC, J&I, and our research group monitor all your funds for performance. And then we also monitor them if any announcements have come out during the recent quarter that you should be aware of. And so we have 4 managers here, Mondrian, IRNM, Loomis Sales, and Morgan Stanley, where we have yeses, meaning that there was an announcement this quarter. And over here in this column, the NAPC due diligence committee recommendations, we're recommending no action. So while all 4 of these managers had announcements, we've spoken to all the managers and we're comfortable with the announcements. And just to give you a highlight of what they are, Mondrian has promoted a PM to the head of the emerging markets small cap team, Graham Cole. He's still going to be working underneath the CIO as he has been for the last 10 years. He's just getting recognized for all of his efforts. Within IR&M, they've reached out to all their clients asking for permission to use ETFs in their fixed income portfolios, not for a long-term holding, but to really help with portfolio liquidity and trading in certain periods of the year. Just given the liquidity that we've seen in fixed income, specifically back in March and April, when markets were going haywire, they're just using it as a tool to enhance their portfolio construction. Within Loomis Sales, and that's your bank loan manager in the operating fund, the CIO is going to retire. The CIO that's going to replace him was the deputy CIO, and they've worked together for a number of years and have very similar philosophies, so we're comfortable with that. And then Morgan Stanley is acquiring another large investment firm, Eaton Vance, that's expected to close in the first quarter of 2021. We don't expect that this is going to have any impact to the Morgan Stanley International Fund that you invest in. And so we're not recommending action today, but of course we'll continue to monitor it as the transaction gets completed in 2021. So I'll stop there and see if there's any questions on any specific manager, any of the specific portfolios, any of the items that I presented to you all.
Kelly, I have just a question for you and Jay, and that is at our last Board of Trustee meeting, we had 4 or 5 comments from either students, staff, or citizens in reference to ESG investing in our portfolio. I'm curious, or more of a divesting of heavy polluters. And I'm curious what your take is, how we're invested there, and how we react to those kind of thoughts we're hearing.
Sure. So maybe just to start with a little history to remind the full committee. I believe it was back in 2014 where we started having conversations with students and other groups about divesting from fossil fuels, and had a number of meetings with that regard. At that point in time, full divestment wasn't easily possible, because to do that, you really need to hold separate accounts with all of your investment managers. You can't divest from a mutual fund or tell the mutual fund provider, Vanguard, that I don't want to hold fossil fuels. So what we did at that point in time is, for the separate accounts that you do hold, which is income research and management and the operating fund, you have divested from coal there. You've also divested in the MIP from Westfield Capital. So you have no coal exposure there. So you didn't divest from all fossil fuels, just coal at that time. And we continue to have conversations with the investment committee, with students and other groups and NEPC. And really that evolved in taking not just a pure environmental approach, but more of a holistic approach, which focuses on E, S, and G, environmental, social, and governance. And we really only did that in the managed investment pool. We didn't do that in the pension fund at the time because of ERISA guidelines, and that you have to invest for the sole purpose of your plan participants and beneficiaries. And there is some language around that can be tricky. And then within the operating fund, that is a portfolio that is very important for, the operations of the university system. And, taking a very conservative approach there, it's mostly fixed income in cash. So at that time, divesting was really talking about equities, and you don't have much equity exposure in the operating fund. So we focused on the managed investment pool. And so what we did is we said, we looked at all these managers, said, which ones are focused on ESG today, and then made the commitment of any new investment manager that we hire into the MIP that we look at ESG. So when we interview the managers, we talk about how they think about ESG. Do they incorporate looking at environmental, social, and governance factors as they're looking at their underlying companies? And from that time, we have hired Walter Scott, who does that. They really focus on ESG. Jay O'Hambro does. Kabuter does. And then when you look at Aberdeen, they really focus on governance. So not so much the ES factors, but certainly the G factors. And then over on this page here, we hired Bain, your bank loan managers, which is focusing on corporate securities. They look at ESG quite significantly. And then GMO has always had a component to ESG in their process. Jeremy Grantham has always been big on climate change. And while this isn't specifically that type of portfolio, there is a component into it in their process. And Newton was hired into this portfolio after we incorporated ESG into our investment policy. Because they do incorporate ESG. So we've made a lot of ground on any new manager that was hired into this portfolio. That one, we hired them because we liked their process. They had a strong team, strong assets under management, good track records, but in addition, have a strong focus on ESG. So
Kelly, over the last 5 years, do you think we've become more ESG centric compared to our portfolio previously? Are we moving in that direction a bit, or?
The managed investment pool has certainly become more ESG centric with all the improvements we've made with the investment managers. And just as a note, I was looking at some data the other day. When we looked at the fossil fuel exposure for the MIP, and we asked all the managers at that point in time, back in 2014, what was your exposure to fossil fuels? It was about 6.5%. We asked these managers and all these new managers that you have, what's your exposure to fossil fuels? And this was back in March of 2020. It was 2.1%. So you've cut, and again, this is just fossil fuel exposure. You've cut by 67% since 2014, just by hiring ESG managers in the portfolio. And naturally, as those managers and the managers you've had in the portfolio make changes, to their holdings over time. But I think there's been a quite significant process for this portfolio.
Those are some wonderful statistics. Over time, it would be interesting if we could at least try to gain a few of those kind of high-level metrics, just so we have some nice talking points on that.
Sure.
Thank you.
What is evident in when looking at all the new trustees and all the trustees in general is that there's a lot of new faces. We're going to have a discussion later with staff as well as Chairwoman Martin, about these issues, and perhaps what would make sense would be further education with this group about the action that has been taken, what opinions were by this committee years ago, so we can have potentially a fruitful discussion going forward where all the facts are on the table.
Yeah, and if we can just also some historical data trends, like just so we have some base point of relevance to work from. If we could benchmark it a bit, I don't think it, I think it's important, and it should be as good corporate citizens, I think we should just be aware of it. And it sounds like we've done some prudent things here to move us in that direction, and it would be just nice to have some additional kind of facts with that. Thanks.
Welcome.
What is truly interesting, and I don't want this conversation to last longer than it really has to, but what's fascinating to me is in the last decade, last 5 years, last 3 years, the industry really has evolved quite dramatically. So a lot of the wishes that individuals have at certain points during that time, it just wasn't feasible. And our job is to tell you what's feasible, what things cost, what the impacts to the portfolio will be. And part of that education we hope to have with you in the future will discuss that, that evolution of the industry over time, what's possible and what perhaps isn't as possible.
Are there any other questions from the committee on any of the portfolios before we move over to the recommendation?
Great. Thank you, Kelly. Why don't you move to page 266?
All right, can you see it?
Yes, yes, I can.
Okay.
So Kelly did a very good job kind of detailing GMO and our recommendation to reduce the global asset allocation mandate. But before I get to that specific recommendation, I really wanted to highlight why GMO was hired and put in the portfolio to begin with. And again, this was well over a decade ago where we did that. And the real number one reason was to get exposure to underrepresented or non-traditional asset classes. At the time we put it in the portfolio, the asset classes weren't as well developed as they are now, and you didn't have the sheer number of managers gain exposure to these differentiated asset classes that Kelly went through. Now you have your program totally built out, and you can get that exposure on an individual basis with the managers that you currently have. The second reason to hire a manager is so that they can perform in excess of the relevant benchmarks. And as Kelly mentioned, they have fallen short on a consistent basis. So over the last decade, they've underperformed in 7 out of the last 10 years, and they fell short by 140 basis points over that time period. What was most distressing to me and Kelly was the fact that they underperformed during the very difficult market environment of the first quarter. And that was really the straw that broke the camel's back. And we mentioned that at the last meeting. And then lastly, you hire a global asset allocation manager to provide flexibility within their underlying asset allocation. And GMO has been less flexible than we would have liked, and they've had overweight allocations to a lot of the same asset classes they've been overweight to for a very long period of time. So they really haven't been flexible and willing to change as the markets change. The good news with this analysis, and this is really highlighted on the next page, but stay on this page, Kelly. What is good about this news is we could terminate GMO, allocate to representative asset classes that you would expect from GMO, and at the same time maintaining expected returns expected alpha and expected volatility that you now enjoy with the program. So we don't think it's going to cost you anything. In fact, we would hope for stronger alpha because GMO really hasn't done that within their history. And then lastly, and again, we don't necessarily want to make decisions based upon cost savings, but the investment manager fees would be reduced by about $270,000 per year. So again, that's just an ancillary benefit of doing that. If you turn the page, Kelly, to 267, you do see the asset allocation and how we would allocate the funds coming out from GMO. And if you, actually, before I get to the specific allocations, if you focus on the bottom part of the chart, that's really highlighted in the blue rows. You'll see expected returns over 30 years. Again, these are long-term returns, don't change at that 6.7. For budget expectations, we're still figuring for 50 basis points of alpha, which leads total expected return to 7.2%. So there's no change in expected returns. The standard deviation or the volatility of your assets also does not change, and that's in that last row at 12.1. So again, we don't think will have any effect on your portfolio. So what do we recommend those changes to be? You see that GMO global balanced row highlighted in green closer to the bottom. You see a 7.5% allocation currently. We want that to go to 0 so that your only global asset allocation manager going forward will be Newton. And what we do is we'd increase large cap equities by 5%, decrease small cap by 1%, increase core bonds by 2.5%, and increase where'd it go? There's a 1% allocation that I missed. The hedge funds long short, highlighted in red, increase from 6 to 7%. And again, a majority of those managers we're going to allocate to. There's a bunch of active managers, but also a passive manager in the S&P 500. A significant number of those managers have generated nice alpha over a variety of time periods. Are there any comments or questions I can answer based upon that recommendation? Okay, I guess it seems pretty straightforward. Chairwoman Martin, is it time to call for a vote potentially?
It is. I want to thank both you, Jay, and Kelly for your market review, performance reviews of our 3 portfolios, and for your recommendation. We're thankful for your expertise, the expertise you bring to the table. And we're going to move to the resolution. I'll read the text of the proposed resolution. That the investment committee approves the following asset allocation recommendations for the managed investment pool. First, reduce global asset allocation from 15% to 7.5% and reallocate to traditional equity 4%, fixed income 2.5%, and long short hedge fund 1%. And the second item, to terminate GMO, the global absolute return strategy. Can I have a motion?
So moved.
So moved by Trustee Bartholomew. Second?
Seconded.
Seconded by Trustee Gardner. And Ellen, if you can take a roll call, please.
Certainly.
Thank you.
Trustee Bartholomew,
Yes.
Trustee Irwin,
Yes.
Trustee Gardner,
Yes.
Trustee Eustace,
Yes.
Trustee Martin.
Yes,
The motion is carried.
thank you. And moving right along, we're doing pretty good on time here. I'm going to transfer the Zoom camera to Gretchen Catlin for the enterprise risk management update.
I was talking on mute. My apologies. Thank you, Trustee Martin. So I will start with page 272 of the handouts. You may recall that in May of 2020, Risk Management provided a comprehensive overview of the enterprise risk matrix to the Audit Committee. Another refresher that each risk has been designated a trustee committee for oversight, as the trustee suggested. In addition to that, we also assigned a management locus of control for each of these risks. That person is responsible for overseeing the risk and the control strategies to mitigate that risk from happening. Overall, the University of Maine system is monitoring 19 enterprise level risks, and one of those has been assigned to the investment committee for oversight. And so today we'll provide you with an update on that one risk. Moving on to page 273, just another refresher for how these risks are actually measured and scored. So they are measured based on materiality, which is the financial impact of the risk, and the scope, which is the likelihood that the risk would occur. When those two are multiplied together, you get a total risk score, which helps risk management prioritize the risk. Moving on, the next two slides gives a high-level overview of the risks that we're tracking at the enterprise level. Today we'll be going over risk number 9, which is an investment decline. As we move through the slides, we're now on page 276, which is the risk that's been assigned to the investment committee, investment decline. This risk has been assigned a materiality score of 4, which is a high materiality impact. The scope or the likelihood is unlikely, so it received a scope score of 2, which gives the overall risk an overall score of 8. So it's a moderate risk for the university. On the next slide, 277, this was provided to us by NEPC, so thank you, Kelly Reagan, for putting this together for us. This really helps us understand how we were assessing the risks by the investment portfolio. So to start, you'll notice that the managed investment pool is for UMS only. That is for the UMS endowment pool. The managed investment pool, which is indicated in the second column, is for the managed investment pool includes the UMS endowment, the OPEB, MMA, and the Law Foundation. So as we look at this, we evaluated the risk of each portfolio as well as the overall portfolio combined. And if you look at the probability of a 1-year loss of 10 million or greater, you can see that it's outlined by portfolio. And overall, the total probability of a $10 million loss or greater would be 22.6%. Next, we looked at, if you look at the next green section, the 2020 actual results. This really helps us see what the impact the pandemic had on the investment pools. So you'll notice that in Q1, when the pandemic first hit in the United States, this is where we started to see an impact to the investment pools. Overall, the control strategies that we will go over in the next slide, and that many of have already been discussed with the previous presentations today, helped us start to recover in quarters 2 and 3. So you'll notice that even though we had a significant loss in quarter 1, the year-to-date financials are looking positive due to those control strategies that were implemented. All right, so moving on to slide 278. This is just a high-level overview of those control strategies. So again, we'll list out, we have the annual asset allocation review, which takes place in the winter. There's diversification of the funds, rebalancing to the target within approved ranges of the pools. We have the investment committee oversight and transparency, which I think is highlighted today with the presentations that you've seen from CapTrust and NEPC. We also have professional consultant that provides third-party advice. We have the investment guidelines, which are reviewed annually. And there's also due diligence reviews, which were talked about previously, for all the investment managers. Performance of each portfolio is also reviewed regularly based on the objectives that are set in the benchmark data, and that information is shared with the investment committee on a regular basis. And so with that, in terms of next steps for risk management, we do plan on attending the Human Resources and Labor Relations Committee and the Academic and Student Affairs Committees in March. We'll follow through with Finance and Facilities and Technology in May, and then give another comprehensive overview to the Audit Committee in May. And with that, I'll open it up to see if there are any questions regarding the control strategies or this risk. Hearing and seeing none. I appreciate your time today. Thank you, everyone.
Well, it brings us to the end of our meeting. Do you have any comments, questions, or concerns about today's meeting? Hearing none, I just want to take this time to thank all of you for your continued service on the investment committee. You know, it's pretty noble of all of you to lend your time and your talent to this committee, and I appreciate each and every one of you. And without further ado, I am going to adjourn the meeting. So have a happy holiday season, and I look forward to seeing you in the new year.
Thank you.
Oh.
Thank you, everyone.
Thank you very much.